Hey guys, welcome back. As tax season is around the corner, some of you guys are probably wondering what are the best ways to reduce your taxable income. So this video is specifically for young couples, particularly with those who have children. So as you guys know, I just gave birth to Naya last year. This is my son Naya. Now I want to say hi to the camera. Hello. So in this video, I'm going to show you 10 strategies that will help you save thousands of dollars in taxable income. I can confidently say that some, if all of those tips will be benefit to a lot of you guys, whether you are a high income earner or not. And if you guys have children or planning to have children in the future, make sure you bookmark this video. It will definitely benefit you down the line. As always, each of my sections will be timestamped down below through the YouTube chapters. So if you're already aware of some of these strategies, feel free to jump to the next chapter. Before I get started, I just wanted to give a quick disclaimer that I'm not a CPA. So please do conduct your own due diligence when you are making those financial decisions. A very important thing to note that some of these numbers could potentially be adjusted, especially for the periods during COVID, to help out with families that have children. Now let's break them down one by one. The first one is the child tax credit, or short for CTC. For 2020, eligible taxpayer can claim $2,000 per qualifying child or dependent under the age of 17. And that number starts to phase out if you have a MAGI, or modified annual adjusted income, greater than $400,000 for family or $200,000 for individual. And how the phase out works is that the $2,000 credit will start to reduce at the rate of $50 for every $1,000 that's above the high income MAGI threshold. So if my calculation is correct, that means if your household income is $40,000 over the $400K threshold, that's calculated by $2,000 divided by 50, which is the rate of phase out, multiplied by $1,000. That's a total of $40,000 above the MAGI threshold. Then you won't be eligible for any of the CDC. So for 2021, this credit actually rises to amount of $3,000 for children under the age of 18 and to $3,600 for any children under age of 6. And they become fully refundable. However, the MAGI threshold has reduced. It used to be $400,000 for family, now it has reduced to $150,000. In addition, the 2021 tax credit will be distributed to eligible taxpayers in advance as monthly payments as early as July 2021. So that's something you guys should watch out for if you are eligible. I'll link all the details on the screen and inside the description box, so be sure to go check it out. So the next one is the additional child tax credit, or the ACTC. Now the ACTC is for those individuals who didn't fully claim the CTC, which is $2,000. This means you owe tax less than the full CTC amount. You might be eligible to get $1,400 back as part of the ACTC. To check whether you are eligible for the CTC or the ACTC, I'll provide the link inside the description box, so make sure you go check it out. The next credit is called the Credit for Other Dependents, or COD. This is for those individuals who don't have any qualified child under the age of 17, but if you do have qualified dependents over the age of 17, you can claim $500 per dependent, only if those dependent meets the certain conditions. These conditions include dependents who are age 17 or older, who have individual tax identification number, parents or other qualifying relatives supported by the taxpayer, dependent living by the taxpayer who are related to the taxpayer. So if you're actively supporting someone who don't fit the CTC requirement, they might be eligible for the credit under other dependents category. And just keep in mind, this one also has a phase out, $400,000 for family and $200,000 for individual. The next one is the Child and Dependent Care Credit. So this credit is up to $3,000 for one dependent or $6,000 for two dependents or more, issued to those eligible taxpayers who are paying childcare expenses for their child or dependent while they work or when they are looking for work. Now, unlike the previous credits, this one doesn't have an income limit associated with. However, the percentage of eligible expenses are higher for those individuals with a lower income. This amount of credit you're allowed to claim is between 20% to 35% of your total child expenses for that year, depending on your earned income. So for example, you can claim 35% of your total eligible childcare expenses if your AGI is below $15,000. So let's say if you're a high income earner and your percentage of eligible expenses that can be claimed is only 20%, that means if you spend $10,000 in a year on childcare expenses for one qualified dependent, then the maximum you can claim is $10,000 times 20%, which is $2,000. So the first four I've talked about so far are called tax credit. So the next one I want to talk about is deduction. Now, it's important for us to first distinguish what's the difference between a tax credit versus a deduction. A credit is something that can lower your tax bill dollar by dollar. So if you owe $1,000 tax and the tax credit is at $1,000, then you effectively reduce that to zero. A tax deduction, on the other hand, reduces how much of an income is subject to tax. For example, if you currently fall in the 22% tax bracket, a $1,000 tax deduction effectively saves you $220 in taxes. So by definition, credit is much better than a deduction, and within credit, there are two categories. There is a refundable credit, and then there is the non-refundable credit. A refundable credit is if your total tax owed is lower than amount of credit, so that IRS have to pay you back. On the other hand, a non-refundable credit just means if your tax liability is lower than the total credit amount, you don't get that extra refund back. So the next one is the tuition and fees deduction. And this one is actually not child specific. You can claim that credit for yourself, for your spouse, or any dependent. The credit amount is $4,000, but it actually varies depending on your MAGI. You can claim the full $4,000 if your MAGI is under $130,000 for family or $65,000 for individual, and $2,000 deduction if your MAGI is between $65,000 to $80,000 for individual and between $130,000 to $160,000 for family. And this number becomes zero if your MAGI exceeds these limits. An important note here is you cannot double dip, which means you cannot deduct or take the same credit twice for the same expense. So for example, the tuition and fees deduction cannot be combined with the American Opportunity or Lifetime Learning credit for any single student in a single tax year. So the next one is Childcare Reimbursement, which is company specific. But I do encourage you guys to check out your company's HR administration website. From my experience, my current company actually has improved that benefit to help out with caregivers and families during COVID. It covers a couple of $1,000s during quarantine, and my husband's company also has the same benefit. Something to be aware of is depending on your company's policy, that reimbursement amount might be taxable. My company in particular has something called a copay, so you need to, if you're paying a nanny or a family member to take care of your child, percentage of that hourly pay needs to be covered by you, and then only the outstanding can be covered by the company. So just make sure you are aware of the nuances of these different policies. I encourage you guys to check out if you're not already aware of. So after address all these credits, deductions, and reimbursement, let's talk about some interesting accounts that will help you out if you have children. So the first one is called Dependent Care Flexible Spending Account, or DCFA, which I have briefly introduced in some of my early videos. So how the DCFA works is it's an account that you can put pre-tax money into, which will effectively lower your taxable income, but that amount needs to be spent during that calendar year. For the year 2020, it's $2,500 for individual or $5,000 for family. Generally speaking, dependent care FSA has a use it or lose it rule, but because of COVID, the COVID relief bill that was recently passed actually allows a much higher rollover amount for 2021 and 2022. So make sure you check how much rollover you can do if you didn't end up spending all the money in that account. Alright guys, this next one, a lot of you guys probably already know, is the famous 529 college fund. It's to save education expenses for your children, whether that's K-12 or college or sometimes even student loan repayments. This account I like because I actually see it as an investment vehicle. The money that goes in is after tax, but then any growth is tax-free as long as you withdraw for education purposes. So if you anticipate that your children will end up going to a college in the United States, then this is a great way to save for that early on. You actually don't have to wait for your child to be born to start investing. You can actually start investing as soon as possible. We started doing it when I was pregnant, before Now was born. Some of you guys might ask, like, what if my children end up getting scholarships or end up studying abroad? You can actually reassign the beneficiary to a relative or another sibling. The 529 college fund is state-run, so depending on where you live, if you live in New York, for example, and then you do the New York-based 529, there's actually additional tax benefit. I encourage you guys to look into it. I live in California, so there's no immediate tax benefit associated with this account. And the limit for 529 is actually quite high. It's $75,000 for individual and $150,000 for married couple. But just keep in mind that the contribution amount, depending on how much you contribute, might be subject to gift tax. So this next one is to open up a Roth IRA for your child, or also known as a custodian IRA. The limit for that is the minimum of $6,000 and the amount of income they generate for a particular year. So more on this later. Before I move on, I want to make sure that all of you guys already open your own Roth IRA. I've actually a big advocate for Roth IRA. I've talked about it a lot in my other videos in this channel, especially the backdoor Roth step-by-step setup. So make sure you do check that out after this video because there are tons of benefits associated with a Roth IRA. I've saved the best one for last. The final one is to pay your children for their work. So how this works is, as long as your children is under the age of 18, you can actually pay them up to $12,000 completely tax-free as part of their earned income. And this amount of money you pay your child can effectively reduce your taxable income. And thanks to the Tax Cuts and Jobs Act, your employee child can actually take standard deduction up to $12,000. That's where the $12,000 came from. And just keep in mind that they have to be doing actual work with a reasonable hourly wage. So let's say if I pay Niall $1,000 for being on my YouTube video, I can actually take that $1,000 and contribute it into a Roth IRA for him up to $6,000, which is the annual maximum. Alright guys, thank you guys so much for watching. Don't forget that for 2020 tax filing, IRS actually extended the deadline from April 15th to May 17th this year. I really hope you found this video helpful. So if you do, don't forget to hit that like button and subscribe to my channel for more content like this. I've also created a customized playlist on tax and fire related videos right here linked on the screen.